Would you believe me if I told you I could help simplify your understanding of fair value gaps so you can consistently make money in the markets? The reason fair value gaps fail isn't because they don't work, it's because you're missing a few key components when trading them. In this video, I'm going to help fill in the gaps, no pun intended, and provide you with a simple outline how I use fair value gaps, which helped me make $21,000 in a single trading day. Now, this video only covers fair value gaps, so if you're looking for a full step-by-step strategy, make sure you check out my simple framework PDF. I'll leave a link in the description. So without wasting any more time, let's get into the video. Alright guys, so we're going to cover a couple different things when it comes to trading fair value gaps, and what I think is a very simplified way of using fair value gaps in a full trading strategy. Now, there are a couple considerations that I take into account when I'm looking for fair value gaps and when I'm trying to pick the best ones to trade, obviously, and then when it comes to dynamic risk, how do I know how much to risk on certain fair value gaps? All right, which is a major, can be a major edge when you're picking A+ setups and you're really trying to size up on those on the setups that really jump out to you. So there's a couple things that we'll talk about when it comes to fair value gaps and when it comes to creating a full fair value gap strategy. All right, first of all, did we take out a major level of liquidity prior to the fair value gap formation? Now, this is going to come in the form of, previous monthly highs or lows, previous weekly highs or lows, previous daily highs or lows, or previous session highs or lows. And the way that we trade to those liquidity levels is going to be extremely, extremely important. Do we have long wicks that occur after trading to those specific liquidity points? That, to me, is a really dead giveaway of order flow changing, which is the essence of a fair value gap. The essence of a fair value gap is to determine order flow. We want to see displacement, and that's really what a fair value gap is depicting. It's depicting displacement, right? Because we have very quick prints on the chart where it's creating these gaps, right? Essentially in price. So did price react favorably after trading into the fair value gap? So once that fair value gap is formed, right, did we trade into it and reject away from it? Now, a lot of times I'm not trading as soon as it touches the fair value gap because I'm looking for reaction in the tape. I'm looking for activity. And when you're getting really good at tape reading, you can see the bid and ask price moving around quite quickly. Now, we don't have level 2 or time of sales data with FX markets, but if you were to go on futures or any of the indices or any stock, when it's trading into a fair value gap, you kind of want to see activity. You want to see large volumes of activity picking up as it's trading into that fair value gap. And what you're going to notice is the fair value gaps that fail or are violated, there's not a whole lot of activity. Like, they trade through them, and the trading is very thin when we're trading into those levels. So when it comes to tape reading, understanding when the market is actually active and when the market is predisposed to go one direction or the other is going to be very important. And that's something that you guys have to just go into the charts and study as you're learning fair value gaps and as you're trading them. Something that you have to observe is, how does the market react once we trade into these specific levels? Is there a lot of volume? Is there any interest in them supporting price higher or lower? So again, did price react favorably after trading into the fair value gap? And do specific events line up, which makes sense from a timing perspective, which is something I'll cover as well. So there's all these different considerations that I'm taking into account when I'm looking at a specific fair value gap. Okay, and is there an obvious draw on liquidity? If there's not an obvious draw on liquidity, many times that fair value gap, you're not going to have confidence in it. Even though it might pan out, you might not be willing to hold the trade long enough for it to see it pan out because you're not confident that the market is going to trade one direction or the other. And when we're trying to place risk in the market, we have to be confident on the draw. Right, and that it's giving us confidence to hold the trade or place risk in the market even after we've taken losses. And when you guys are going to see me, the trade example that I'm going to bring up just in a little bit, you're going to see that I've taken losses, but the same idea was still intact the entire time. All right, and this is what makes trading these fair value gaps. It can be simple, and this is what I'm trying to impose to you guys, is that when we're trading fair value gaps, don't just give up on it after a failed trade. If the idea is still solid and your risk management still aligns, there's reason to continue trading that direction as long as that fair value gap is not failing you. Okay? As long as we also have an obvious draw on liquidity. So all these three things, are four things leading up to this, right? Do lower time frame fair value gaps, then support the idea of the higher time frame fair value gap thesis. Okay, so what we're gonna see when I hop into the charts is kind of going through all these different things and just making sure that I have all these considerations laid out before I decide to trade a specific fair value gap. Okay, so one thing that I think is key if you're struggling with fair value gaps is, instead of trying to trade the initial movement into the fair value gap, learn how to trade the continuation. So after we get a rejection from that fair value gap, then try and place your trade and put your stop loss below the old higher low that was created after we've moved away from it. Yes, you can trade as the market's trading into the fair value gap, but it requires you to be a little bit more nimble and be okay with the market trading against you as you're trying to position yourself inside that fair value gap. So many times, I think the stronger play is the continuation play out of the fair value gap once we get rejection. Okay, so let's hop over into the calendar and just quickly review. Just keep in mind, I am going to talk about New Zealand dollar. So this is this current week, August 4th to the 10th. So Monday, I was expecting some type of price action, obviously coming into the week pretty strong with a high impact news event, which we got. And we'll see that once we hop over into the charts. And then New Zealand dollar, which was kind of at the top of my watch list, which is the trade that we're going to review just shortly. And I'll give reasonings why I chose New Zealand dollar over some other assets. And a lot of times I have a basket of assets that I follow, but I'm only trying to pick the best ones. Okay, I'm not seeing fair value gaps on other pairs because maybe there's a ding against specific parts of my checklist, right? Which we kind of went over, right? Maybe we didn't take out a major level of liquidity, or maybe we didn't react favorably at a specific fair value gap. All right, and these are all things that when I'm looking at multiple markets, I'm trying to filter out all the assets that I don't want to trade and only focus on the one that is going to give me that A+ setup that's really prime, that I can put size behind and really hit it out of the park. Okay. And we can talk about risk management when we get into the chart, but you'll see that I really do size up on my A+ trades, which is why I think I have a pretty decent edge when it comes to trading some of these setups, is because I don't lose faith in the setup. And when things really align, then I'm sizing up, as long as I can have a decent stop loss to also not take on too much risk, but also be able to size in and really run the trade to full profit target. All right, so again, keep in mind that we did have New Zealand employment change on Tuesday, and Monday we had ISM services PMI. So let's hop over into the chart real quick. So this is price action on Monday. All right, and what I was looking at was this bullish fair value gap. I thought we were really going to respect that level, but when ISM services came out, we got a really strong rejection lower and then a rejection higher to close the day. And this is oftentimes why I'm only taking one to two trades a day. If I get it wrong on a Monday, I'm most definitely waiting until the next day. I'm not in here constantly clicking buttons, and I'm not in here constantly trying to take trades, because I know that my opportunities will come from just sniping out those really prime setups. And I'm going to walk you guys through all the key considerations that I used when it comes to trading fair value gaps, and why some of them might fail on you, and why sometimes the continuation play can often be better than trying to trade the initial run. So as you notice, if you were to try to trade the initial run on this day, right, we had a really strong push lower to take out the previous week's liquidity. All right, so this is Monday's low. This was Friday. So we ran really hard on a Monday and then rejected and closed higher. So you're going to see that on Monday, right? A lot of times when we get a really strong run on Monday, many times when this range is really big like this, a lot of times that's the low of the week. All right, and I know some of the stats say that 70% of the time that the higher low of the week is made on Tuesday, but sometimes when we get a really strong move on Monday, like we saw from that ISM services release, and we get a really strong closure on the daily here, right? This is lining up for a really solid long position. Now, my target really was just these equal highs up here. So we had Thursday's high and Friday's high. And as you can see, they were very, very close to each other. So once I have this information, right, we had a really strong rate on liquidity. So that was our major level. And this was April's lows. So not only did we take out the previous week's lows, but we took out a previous monthly low as well. And we got a really strong rejection, and the daily closed above the buy side imbalance. So what I then do coming into Tuesday, right? I know that Tuesday, if we just look at Tuesday, 6:45 p.m., we have employment change. So I really am active during New York session. So when I came to the charts during New York session, and we will obviously get there, but this is essentially Monday's price action, right? So Monday we had a really sharp run lower, and then a rejection through the rest of the day. Overnight there was a run lower, and then we had ISM manufacturing here. So overnight we actually ran lower. So during London we ran lower, and then ISM printed this, right? But I was assuming that we were going to run above the equal highs during ISM, which did not happen. So coming into Tuesday, we had this inverted fair value gap, which I'll drop the screenshot here of me actually sending that to my Discord, and what kind of what I was looking for going into the following day. So let's play this forward. Obviously, we are inside of that daily fair value gap, and we still have this inverted fair value gap. And I actually went long here, and you're going to see that I took a loss because I did not take profits during Asia. I thought we were going to get back above these highs, but during London session, we actually came back down into the inverted fair value gap. And now this is where having confidence in your trade thesis and completely avoiding the low time frame noise, right? The low time frame is really just an alignment of my high time frame thesis, right? So based on this daily candle, right, I'm looking for those signatures to remain in play, all right? And with the actual daily closure on Tuesday, so this is all Tuesday's price action. We came down, ran out Monday's low, the intraday low from New York session. So we had lunchtime, and we traded down into that inverted fair value gap. Okay, so I got stopped out here below these lows because I didn't think that we were going to come back down into the inverted fair value gap. So my initial long was in here. I did not take profit above this high, which I should have done. All right, and this is where you guys can learn from my mistakes as well. I did not take profit as we were approaching those equal highs. But the daily still lined up in my favor. Just because when I'm looking at the 4-hour and the daily chart, usually when we see really long wicks like this and really long wicks like this, where we're taking out major levels of liquidity, oftentimes we are going to see a much deeper retracement as it pertains to this range here. And this is kind of my draw on liquidity here, as well as some of this liquidity up here, which we haven't yet reached into at the time of this recording. If you're enjoying this video but want to find out how you could speed up your trading journey and trade live with me week in, week out, like Jessica here, who made over 3 ER taking the same New Zealand dollar trade as me, then make sure you apply using the link in the description. So as we traded down into the low end of this inverted fair value gap, okay, I had already been stopped out once. But coming into the New York session the following day, knowing that later in the afternoon we do have employment change, I'm still leaning bullish even after taking that loss. So I positioned myself long again inside of here. And then once we got that hourly closure outside of that inverted fair value gap, right, that's really kind of all I needed as far as indication that we were going to run to these equal highs up here. And when we get into the actual, the trade transactions, I'll show you guys what time I actually entered that position. But as we got onto here, right, the biggest thing for me was the thesis that I still had was still intact. But let's say if you did miss the entry inside of this inverted fair value gap, or anywhere in here really, your next entry would have been after we got this displacement out of here, right? Because we got this fair value gap that appeared here. Really didn't want to see that traded down into, because we've already rejected this inverted fair value gap. We've taken out liquidity All right. So going forward, let's see if we get that expansion going into 6 p.m. So this is 6 p.m. There we go. Boom. Took out that liquidity, ran higher. And this is basically where I exited the trade up here. All right. So that's really the trade idea. And it's really based on the daily time frame. So if we look at our daily time frame, all right, you can see how even the following day, right, traded lower. But if we just study how the daily closed based on the price action, right? We created a higher low and a higher high. So going overnight, holding into the rollover period, right? 6:45 p.m., I was comfortable holding that trade overnight through the news. All right, because everything lined up for me still. We got a rejection away from the daily fair value gap. We had the inverted fair value gap on the lower time frame. All right, and as you notice, like I'm really just basing my whole trade idea off of the fair value gap rejection on the daily. So everything is coming from this one fair value gap, all right? But it's how do we trade around that specific fair value gap? Well, I have all those considerations that I went over previously, which I'll bring up again just to quickly run through. Did price take out a major level of liquidity prior to the fair value gap formation? Yes. Did price react favorably after trading into the fair value gap? Yes, even though I took a loss, which we'll get into. It still was reacting favorably on the daily time frame. I'm not letting any of this low time frame noise throw me out of my trade idea. Okay, even though we took out this high and ran back into the inverted fair value gap, this daily fair value gap, right, takes precedence over this 1 hour fair value gap. All right, so even though we traded lower here, all I'm looking at then is once I get stopped out, I'm just looking for a reason to re-enter. Okay, and my reasoning might be a little different than yours, but we did have another fair value gap in here on the 1 hour time frame. Okay. So there are, fair value gaps that obviously on the low time frame line up with my high time frame thesis. So taking out liquidity, right? Even just from a fractal standpoint, taking out a major level of liquidity here could be a reason enough to go long after we've traded into this fair value gap here. But let's say if we did miss this, trading the continuation after we get a run outside of the fair value gaps, just going market order long after we've traded away from it, after we get this displacement is enough. We could easily plot, let's say if we were to enter here, and let's say you were sloppy on the entry, putting your stop loss here and putting your target at the equal highs, it's still enough for a 1.5 to 1 risk reward. It's not terrible. You could even get a 2 to 1 out of this if you were taking into consideration 20 pips above those equal highs. All right. So a 20 pip run above those equal highs would have been enough for a 2 to 1, which in my opinion it's good enough. All right. So again, going back to the considerations, do those specific time events line up, which makes sense from a timing perspective. So from a timing perspective, yes, Monday, we got that really crazy run lower during London session, and then 10 a.m. Didn't really provide too much of a retracement, right? So 10 a.m., this was our retracement 10 a.m. So here, again, obvious draw on liquidity, those equal highs were definitely obvious. And do those low time frame fair value gaps support the high time frame fair value gap thesis? Yes. So as you guys can see, this was really, to me, an A+ setup. And this is what makes things so simple, is because you guys don't see a whole lot of moving parts. It's just a fair amount of context around the market, having the right timing, and being confident in that fair value gap that I'm trading, not to have to switch my bias even after getting stopped out is extremely important. So with that being said, let's hop over into the actual trade executions and we'll review that quickly. All right, guys, so let's quickly go over the transactions from the trade idea using the fair value gaps. So as you guys can see on 8/5, which was Monday during New York session, right before ISM manufacturing index, I took a long position because I saw that we had created that inverted fair value gap during London. We had ran out old monthly lows. So I was using that inverted fair value gap as an entry, expecting that we were going to get the run on equal highs. But if I pop over my chart right here, essentially this is my position right here. So you guys can see during 9 a.m. I took that long position, and my stop initially was at the low end of the inverted fair value gap. So you guys can see that I never got stopped out there. So my target was up here, right? So 2.5 to 1 risk reward initially. So you guys can see, you know, exactly at that time, this was at 8:52 and 9:06. So going into this candle, right, I was positioning myself long already. News came against me, but that was okay. I was totally fine with sustaining that run. So 9 a.m. where I got to push higher. I thought that 10 a.m. was going to carry us higher, but because it came back on me and my stop, I was paying my stop to do his job. This is where having patience with the trade idea and not panicking when we have some of the signatures in place, right? We have the fair value gap. So this is our daily fair value gap, by the way. So we have the daily fair value gap. We ran out a ton of liquidity. We created an inverted fair value gap. And, you know, I was basically putting my stop loss at the low end of the inverted fair value gap. But what happened was during Asia, which I did not anticipate us getting a deep run on, Asia pretty much rallied hard. And what I did was I cut my risk in half, essentially, or a little less than half. So I cut my risk just to take something off the table because it was running to my target pretty nicely. And I went to bed basically at 8 a.m. Sorry, it's 8 p.m. to 10 p.m. I was expecting that maybe we're going to get this run lower on the hourly and then a continuation going into London session. But as you guys can see, based on the transactions, I actually got stopped out around 3:30 a.m. So, you know, this initial position ended up being a loss of 2% roughly. So it came back, stopped me out. This is the 3 a.m. candle, by the way. You know, stopped me out. Actually, I think my stop was a little bit lower. I think it was at this imbalance here, the 1 hour imbalance, because I didn't get stopped out at 2. I got stopped out at 3. So I got stopped out at 3 a.m., 3:30 a.m. roundabout. And then I came back to the charts during New York session. And essentially what I did was I traded the continuation after we got the rejection from this inverted fair value gap. All right, I didn't enter down here. As soon as we got this hourly closure, you guys can see that I entered at 9:37 and 9:45 were here. And I actually sized up on those positions, and my stop loss, you know, was basically again at the 50% mean threshold of that fair value gap. So when I went long on my second position, it was here. My stop loss was at 50% of the inverted fair value gap, because when we get displacement like this, right, that's the continuation play I'm thinking about. Is, you know, this is after we've gotten a rejection away from that inverted fair value gap, and a strong rejection, mind you. So not only did we take out liquidity, we respected this smaller 1 hour fair value gap. I still had the thesis that it was going to go higher, and my take profit was much higher above the equal highs. So you guys can see that, you know, I sized up on this position, and I made sure to start cutting my risk pretty aggressively as it started moving my direction. And then right prior to the 6:45 p.m. news release, I pretty much went break even. So, you know, this candle right here was the 6 p.m. This 5 p.m. candle closed at 6, and then this candle was the one that sent us higher into the equal highs. So after the 5 p.m. candle closed at 6 p.m., right, based on that calendar, pretty much went to break even, took all the risk off the table, because I had a fair amount of risk just based on the size I had put on. But again, everything lined up for me to be able to risk dynamically. So you guys can see that this was a really massive win. But it's only because I have a conviction on the higher time frame. I'm not sizing up like this on every single trade. And what you guys are going to learn over time and from experience is that you really only want to size up on the trades that really stand out to you. And when you size up on those trades, that's when it's going to make up for a lot of those losing or sideways market conditions. Is when you have market conditions that really line up in your favor and all the stars align, that's when you really should try and hit it out of the park. I'm not telling people to risk their entire accounts on a specific trade. You guys just saw that I was in a bit of drawdown. I think I was in 4% drawdown total. But again, I don't really care about blowing accounts. Like, I'm in a position now where I can risk 2-3% on a specific trade. And I kind of have adjusted because I've lost a lot of capital. If I still had the same amount of capital as I did last year, I wouldn't be risking 2-3%. But I know how to trade. I know when to size up, and I know when to actually take advantage of some of these setups that pan out. So I hope you guys enjoy the video and learn something useful that you can apply when you're using these fair value gaps. Don't forget to like, comment, and subscribe, and I'll see you guys in the next video.